Good afternoon, everybody, and thank you for joining us today for our March edition of the SRG Off Script. This is our live version of the podcast that we are doing and recording. We'll be sharing with you. It's our opportunity to sort of pull the curtain back and let you guys sit down with us and maintain a dialogue, talk, answer your questions. As far as today goes, just a couple of quick housekeeping items, and then we'll get into the good stuff, the meat, as you all get set up here and log in. We are going to go through and answer live questions today that you can submit through the Q&A panel. We'll be keeping an eye on that throughout the session, frankly. We also have questions that were sent in ahead of time. A couple of you that had sent those. We had a bunch that were generally asking in different ways the same questions. So we've curated and condensed those down to the core questions that were asked, and have probably, I think, about a dozen of those that were sent in, which frankly, between the few set of questions that I have just to frame our conversation today with my esteemed panelists, Ryan Grau, we will have a set of questions. We'll hit the questions that were sent in ahead of time, that we'll sprinkle in your live questions that come in. So do feel free to use the Q&A panel. If you have any technical difficulties, you can also use the chat function that's in here. The session is being moderated, not by me. So if you need help, any assistance, let us know. We'll try to do what we can. Beyond that, we also have a couple of just real quick hitter polling questions that we'll just put those up now so you can participate and share with us your perspectives. The poll questions are nice for us and incidentally you, because it gives us a chance to get feedback from you in real time. Number one, on questions that I think you will find interesting and useful as we publish the feedback for you, as in the responses from your peer group who are here today. But also beyond that, it helps us then tailor a follow-up to you so we can bring you additional resources, content like today that is more specifically aimed at what you guys are interested in. So keep an eye out for the poll question. We'll pop that up here momentarily. I think there's 3 quick ones. They should be relatively easy. There you go. And again, we will publish those so you can see kind of where you land relative to the peer group that's here today. Beyond that, for those of you who were kind enough to register for today's session, but not have a lot of background into who Succession Resource Group is, I don't know how many of you fall into that category, but let's start there. So who is SRG? Short Clip Notes version. We are a consulting organization headquartered in Portland, Oregon. Our consultants, team members are frankly throughout the US at this point. But we honestly focus on knowing a lot about a little. We really just focus on, I'll say, succession planning, obviously given our name, Succession Resource Group, but more specifically, the things that impact the value, the equity that you have in your business, which, as you can see on the right here, the value, improve, protect, grow, and then exit, sort of the individual lanes that we group our services, expertise, and teams around. It's not just the traditional M&A solutions. I mean, it is those for sure in spades: value, mergers, acquisitions, succession, buy and sell side representation, things like that. Yes, we most certainly do that, as you would expect. But if you look at some of the other things that are improved, for example, entity formation, employment, compensation plan design, things that I would tell you, quite directly impact the work we'll do with you on acquisitions, on mergers, on succession planning. But they're kind of foundational to the succession planning and M&A work that we do. And it's the only reason why, frankly, we do compensation plan design or employment agreements or setting up entities, is because it is such a pivotal step, and it impacts the value, how you exit the business, how you grow. So it's a wide array of topics, but all really geared around the value and equity you have in your practice. So with that, joining me today from our team, I think we had a team of 18, maybe 19 at this point, but of knowledgeable industry professionals. And I've got one of those here with me today. Fortunately, my brother, so I can give him a hard time today with some of your questions here and ask him the curveballs. Ryan's got a ton of experience and background, and I would make an educated guess at this point. He probably singularly, let alone with the team, has valued more advisory practices than anybody else who does this probably combined. So we're going to draw on that experience here today. And frankly, again, SRG Off Script Live, get his perspective on things. Again, not our curated annual or mid-year updates, which we do, and they're great, I acknowledge, but this is kind of the real-time finger on the pulse of things, get his perspective. So if you want to jump in, ask questions, I will make sure we read those in today. But we did have a lot of great questions that were sent in ahead of time. So I'm going to plan to start there. I will moderate. We'll likely, ping pong some stuff back and forth because it turns out I do have an opinion on occasion on this stuff. But the good news is today, while I have opinions on it, Ryan and his team, eat, sleep, and breathe this stuff. So we can get really deep, really, really quickly. With that, let's start with the questions that were sent in ahead of time. I've got a couple of, we'll call them setup questions. I certainly would put them in the softball category, but it will get our conversation going. And I hope end up leading to questions that will get prompted from you all, which I know we've already got a couple of them here. Thank you, Jeff. We'll get those weaved in here momentarily. But let's start with an easy one here. So, Ryan, you've probably evaluated, like I said, more financial service businesses. I'll just use that term generically for all of us here today to mean folks under an IBD, RIAs, folks on the insurance side, tax side. That's probably about as far afield as we get, but that's what I will refer to as a financial services business in category. So you value probably more of these financial service businesses than most of the other professionals that I'm aware of. Would you share maybe just a little bit of background observations, what you've seen? I know it's not your first rodeo. You've been doing this for, I think, over a decade at this point. What are your thoughts on advisor valuation?
The financial services industry is unique from other industries, given the fact that they've got the ability to generate recurring revenue. So the fact that they can generate recurring, stable, predictable, and scalable revenue is one of the key value drivers in these practices. And even though we're going through turbulent times in the economy, not all practices are reacting the same. So on an annual basis, I typically will review and sign off on close to about 1,200 valuations. Some of those are practices on the smaller end of the spectrum. So let's say under $500,000 in top line revenue. Some of those are on the larger end of the spectrum, which would be north of $10 million in revenue. The smaller transactional based practices, more lifestyle practices, are the ones that tend to be the most affected by changes in the economy. Those practices are typically single owner, maybe one licensed professional, but they're really hedged against growth and changes in the marketplace. So when there is a decline, there's an impact to their assets, which has a direct correlation to their revenue, which has an impact on their value. On the other side, with larger, more established practices, where they have a team that is working together to focus on building out the services of the entity and servicing the client. Sorry, the screen just switched there. They tend to be better hedged against changes in the marketplace. So while there certainly is a decrease in assets, typically what we see with their revenue growth is not decline, but rather they hit a plateau and it starts to level off, or their growth is less than what we would typically see compared to a year like 2021. But for the most part, in some financial advisory practices are unique. They have a strong, predictable, scalable, and reliable source of income. There's a very active marketplace for these practices. As such, we're seeing valuations for the most part holding pretty stable right now.
Got it. And we have a few other questions, as you know, that we will tee up on that very subject, but we'll come to that here momentarily. So there's a lot of talking heads around the topic of valuation at this point, and frankly, us included. But there's a lot of consternation in many cases on the valuation methodologies, looking at top line revenue versus bottom line, as in like net income, EBITDA, EBOC, things like that. And as I listen to some of these pundits, they will talk about one of those two being the right answer. Your thoughts, Ryan? Top line valuation methods versus earnings based, right or wrong answer? Which one's the right?
If there was one true method for valuing a business, it would make my life a lot easier. Unfortunately, it's not that simple.
Yeah.
Value, of course, is going to be driven by purpose. And what that means is the reason that you're having your practice valued is because you're looking to transact in some way. We need to know what that transaction looks like. Also, the valuation analysis is going to depend on how complex the practice is. So working through those scenarios, if your purpose is an outright sale, you're selling a controlling interest, there are a couple methodologies that we can use. We can either use a market approach, or we can use what's called an income approach, where we measure cash flows and net income. A market approach tends to lean more towards measuring earnings and gross revenue. Excuse me. So for a smaller practice, again, typically under 500,000 in revenue, you start to see practices, around $1 million, maybe pushing 2 million may fall into this category, but they don't have very complex structures. It's solo advisor. And within that, what you're selling isn't a going concern. You're not selling intellectual property. You're not selling software that you've developed, or your actual process for providing advice. What you're transacting is your book of business, the assets, and the revenue that are associated with it.
Yeah.
So in those scenarios, we're going to place less emphasis on the earnings of your practice, because acquirer is going to base their assessment of value on what it's going to cost them to take that book of business and roll it into their practice. As such, using an EBITDA multiple for that particular purpose in that size band of practice isn't best practice. Typically, we would look at a gross revenue multiple for determining value in those scenarios. And when we look at the transactions that are available, not only for the deals that we've done at Succession Resource Group, but other outlets where we can access transaction data, there's a very strong correlation between gross revenue, or GDC for registered reps, and the actual value for a firm. When we look at larger practices, the most common purpose there isn't an external transaction where there's a controlling interest being sold to a third party. As such, usually what is happening, or the common request is they're looking to create equity pathways. And when you're looking to create equity pathways, your focus shifts away from just relying on value of the book of business, which that is an integral part of the valuation analysis, but it shifts to cash flows. What you are selling are rights to those cash flows. As such, we need to use a valuation methodology that places more emphasis on your going concern, the revenue that's coming in the door, what it costs you to support that revenue growth, and what is available for distribution. So that's, as an owner, what you're buying into. So for practices that are looking to engage in succession plans, creating equity pathways, we would typically use an income approach, measuring cash flows. We can also still use a market approach, but we're going to shift away from placing emphasis on a gross revenue multiple to more of an earnings multiple. So
Yeah, which is critical.
Your question.
Yes, I've seen that with succession planning, where it seems simple in the valuation, and it's a valuation that someone did, and it's based on the top line revenue. And for whatever reason, a bit of an anomaly, they've got a high cost structure, and all of a sudden the team simply can't make the equity sharing work to hit those numbers.
Yeah, and that's a good point. At the end of the day, valuation is a function of future cash flows.
Right.
So if it doesn't cash flow, then it's most likely overvalued.
Yeah, right. And that becomes a real challenge. Unfortunately, you and I both know, once an owner has a number in front of them and they like said number, that's now the anchor point. So it is important, I think, to understand, as you stated, that there isn't a one size fits all approach. I mean, there is a one size fits your practice or your business. And it's not a good or bad thing necessarily. It's just right tool for the right job. So agnostic of the methodology, let's start getting into some of the kind of fun stuff that folks can actually do something with. Any thoughts, examples you could share, maybe just keep it to one or two, like critical value drivers or detractors, things you maybe seen recently or just stand out in your mind of things to make sure you do if at all possible or avoid if at all possible. What do you think?
David, apologize, but I'm going to be long-winded again.
I have a mute button, fear not.
The answer to this question is really going to depend on where you are in your business maturity cycle. Smaller practices are going to focus more on developing their book of business. So their emphasis should be making sure that there's recurring revenue and that you have a diversified client base. So those would be my top two focuses there. Third would be look at your pricing structure. Make sure that you are competitive. You don't want to be the value provider of financial advice out in the industry. You want to make sure that you're right in the sweet spot and that you're competitive in pricing and service offering. For larger firms where they are looking to create equity pathways, the focus should still be on recurring revenue, diversifying your client base, but now there's more emphasis placed on the enterprise, focusing on your operating costs. And for most firms, the largest operating cost is human capital, the assets that you invest in to help you grow and run and operate your business. And making sure that your compensation is structured appropriately and that it's scalable as your firm grows, that you're able to create profit. And in turn, when the time comes and create equity pathways, that when you're selling those shares, that you're able to get maximum value for them.
What are your thoughts kind of heading down that same rabbit hole of the myriad of responses? Yeah, you could have picked as key value drivers or detractors based on where they're at in their career path. What are your thoughts on impact on the valuation of a practice, agnostic of size, when they're using revenue-based compensation for their team members?
Restate the question, please.
So I'll give you a more specific one. So I had this come up recently. So $1 million practice, I'll keep it a simple example since it's mine. So $1 million practice in annual revenue, simple fee only RIA. They've got a key team member, client facing, taking care of clients that gets paid 40% of the revenue for the portion of the book that he's servicing or she's servicing. And it's basically a payout of their $1 million in revenue. They're paying this individual $200,000, but purely as a percentage of the revenue for the book they're servicing. What are your thoughts on how that impacts, like that cost of goods sold? How does that impact the value of the practice? Because we see a lot of that in the industry.
Yeah, it has a negative. It has a negative, in fact, a detrimental impact to the value of the practice, because you are effectively compensating somebody as an owner. So you've now removed the incentive that as your firm grows, for them to shift their focus on continuing to grow and grow the operations of the firm and focusing on creating more profitability. So what happens in those scenarios is, when there isn't equity, when equity pathways are created, there's a conversation that has to happen before of restructuring compensation. And it's, as you know, that is not an easy conversation to have. It's a very sensitive and delicate conversation. Right. And if it isn't handled appropriately, and there isn't a good strategy in place to make that transition where it's a net benefit to the person who is going through the change, you run the risk of losing the talent and assuming that talent has goodwill and relationships with the clients. If there aren't restrictive covenants in place, those clients may end up going with them as well.
Yeah. When you made the comment on you're basically paying them like an owner, and I would say almost even worse, because again, the limited projects I still get the pleasure of touching and working on is around succession and equity sharing. And being an owner, I would tell you, if your employees, team members get paid based on top line, they're actually getting paid better than an owner, because while the owner might sometimes get paid the most, they always get paid last. revenue-based compensation, they literally get paid first. And so you run into these issues that when you pivot to succession planning, like, hey, Ryan, would you like to buy in? You can now get a percentage of the bottom line. Well, if I could have a percentage of the top line or bottom line, I'll just take the top line and I don't even have to pay for it to buy in. So it's a real pain from a succession planning perspective. And I imagine, yeah, it's got to have a detrimental impact on the value of the business, but also not easy to change. But it's why it's worth having these conversations as a group here today.
Yeah, David, just real quick,
Yeah,
given your experience in working with advisors, why is that such a common compensation package or compensation, I'll call it a plan? But
yeah, I'll couch this one on informed speculation. I think it's partly obviously where most of the industry grew up, which was wirehouses. And how do wirehouses pay their folks? Well, they're out there recruiting and hiring hunters, people who can go close business. So they pay them a percentage because they're salespeople. Salespeople get paid a percentage of revenue. I mean, it makes a ton of sense. Compensation drives behavior. We want them closing business, therefore. And then you go independent and you bring those compensation models with you too. When you're hiring somebody, especially when you're new and growing, to your earlier point on the career track, if you're going to bring somebody on and you are now making $200,000 or $300,000 your early career, but you need help, well, you can either bring somebody on that costs you $50,000 or $60,000 like every 2 weeks and they're on payroll, or I try to bring somebody over who will just come over with a small book or a lot of ambition, and I'll just give them a percentage of whatever they can close. It's kind of a compensation model that early on can't not work. But it's also, I think, one of the main reasons why we're in such a graying industry. Like when you think about trying to recruit talent into our industry, and how does a new college grad who went to school for financial planning nowadays, like how do they come into the industry and get paid? Well, they can go to Ed Jones and knock on some doors and have a declining payout and sink or swim. It's not the most exciting or sexy compensation package for folks coming out of college. And so basically, like if you can't go teach, English in a foreign country somewhere else as your plan B coming out of college, then you go into the financial services. So I frankly am most excited about the larger firms in this industry already shifting to a salary and bonus structure and paying a living wage to their Gen 2, Gen 3 folks, because it's going to make our work on succession planning so much easier. So what about age of clients? Ryan, I talk about Gen 2, Gen 3. It's important to build a multi-generational firm, but what are your thoughts, the age of clients, given that is like the thing that has value in these businesses? How does that impact value?
Generally, the assumption is the older the client, the shorter the relationship is going to be with that particular client. Yeah. And most importantly to the business, they're entering the withdrawal phase of their wealth cycle. So they're no longer contributing as many assets and they're going to start drawing down those assets. So it's not going to bolster or maintain growth of the firm. In conducting many studies in this industry, there's a very strong correlation to the average age of the client base to the average age of owners. So when we see a 65, 69, 70-year-old owner, it's not uncommon to see clients in that 65 to 70-year-old age range as well, without much diversification. Now, if we look at a multi-owner firm where you have a 65-year-old founder who's partnering with a 38, 40, 45-year-old partner, what you tend to see is a shift in the client demographics, that there are younger households that are coming in. And the benefit there is those clients, they may be approaching their peak earning cycle. They're maybe paying down debts, but the offset there is you have a much longer expected relationship with those clients. And it's not uncommon in this industry to see 20+ year relationships between a financial advisor and their clients.
Yeah. Okay. Well, my next question was going to be, ways to mitigate that risk, but we'll put that under the asked and answered category. Let's weave in one of the audience questions here, because it's one that I frankly had teed up anyway, because we've had to ask in a couple of different ways. So The first one I'll take here is one that everyone probably knew was coming, and that's from Bill, your question that was asked most recently. Current multiples, recurring, non-recurring, or transactional. What are you seeing out there? Where are we at?
On recurring revenue for a gross revenue multiple basis, it's going to be impacted by profitability, growth, and size of the practice. Not uncommon to see a well-run practice sell for about 3.3 times. On the higher end, if I had to pick an average, I would say closer to about 3 times. On an EBITDA basis, and I caution EBITDA because this is a earnings multiple that most people don't fully understand, and it is based on normalized compensation. But it's typically seen for a fee-only RIA between about 8 and 9.5 times, most common.
And to your point, obviously, it exists within a range.
Transactional practices are much harder to predict and put an average on because there are various products, annuities, specifically fixed annuities that have longer surrender periods. So typically they're going to be a purely transactional practice, which we don't see that many of. You're going to be under 1 times gross revenue multiple. Could be close to about a 0.8 to a 0.85, but I've also seen some even lower than that.
Which is a good lead into one of the questions that Mark had sent in ahead of time when we were getting registered, when he was getting registered, and that is long-term trends. Advisory businesses getting more or less valuable? I know it's some speculation, but we've got a room full of professional planners here. Do this stuff for clients all the time. What do you think? Where are things heading?
Right now is an interesting time to be asking that question. If we were to rewind to 2021 and going through that period, up until that point, advisor firm valuations have steadily increased. And my job as an appraiser is to keep a pulse on what's happening in the marketplace. So when our M&A team, when they complete a transaction, that information comes over to me. I review it. It goes into our valuation models. Normally, not having to make too many adjustments, maybe a little minor edits, here and there over the course of a year, again, just to stay on top of the trends. But in 2021, we saw, I observed the fastest growth in firm valuations that I'd ever seen. And I was making updates quarterly, like significant updates to our valuation models in order to keep up with the transactions that were coming in. Right now, going through 2022 and the markets that we're in and interest rates, definitely has been a cooling down in terms of mergers and acquisitions, which is the intent of rising interest rates.
Right.
But it hasn't had a material impact on valuation results. Valuation results are still strong. Buyers are being more strategic about who they're buying and what they're paying. So my forecast is still going to be a seller's market. I don't know that ever will change in this industry. It's a seller's market. Values are holding steady. Revenues and AUMs for most practices, they're still growing, just not at the clip that they have been historically.
Well, and frankly, if you're a buyer listening today, put your earmuffs on. I would say these businesses in general, I think, are still undervalued, even at the 2.5 to 3.5 times top line revenue or the 8 to 9 times earnings. And I say that not speculation, as in put these deals into a spreadsheet. You can literally go borrow 100% of the funds that you need in many cases from an industry lender, even at today's rates, which I will fully acknowledge suck by most standards. Maybe not compared to the 80s, but recently the interest rates are not good. So it's going to eat into cash flow. But even net of debt service, including 9% interest rate, and taxes and the expenses, because you'll have expenses to operate the business. Net of all of that, using 100% of somebody else's money, these deals most of the time are still cash flow positive. Not like by year 3 or 4. I'm talking year 1 through 10, which should tell you these businesses are still undervalued. And so I think to Ryan's point, it's, the seller's market's not likely to change. I expect over time it will kind of by default soften a bit, but soften is not the same as changing to a buyer's market. There's just so much healthy consolidation that's already starting to take place. Teaming, mergers, advisors, RIPs, folks who are kind of retired in place that are selling their business. Like the next generation is ready to roll those firms up. And I mean, frankly, seems like even buyers who aren't necessarily prepared, they wouldn't call themselves aggregators, they could roll up 3 or 4 small practices over the course of a career. And I think we're going to see more of that here. So Jeff Broadhurst had submitted a question, Ryan, that we had a bunch of versions of this questions asked ahead of time. So I'll ask his since it's live. You just touched on it. So interest rates have gone up. Yes, don't disagree. Have valuations gone down? Kind of your thoughts there. And then his comment here, you can read the follow-up note if you're looking at the Q&A. So if so, then is it advisable to wait a few years for interest rates to go back down in order to achieve a higher valuation? What are your thoughts, just academically, practically?
I'll steer clear of the academic answer because I like to ground my analysis to observed transactions and sound logic. Sometimes those don't always go together in the world of valuation. The short answer is in theory, yes, the rising interest rates have an impact on valuation. However, what is unique about mergers and acquisitions in this particular space is seller financing. Since you're selling intangibles in almost every transaction, there's some form of seller equity infusion and a performance adjustment based on successful transition of the client assets. As such, haven't seen a significant change in valuation multiples. Haven't seen a change in purchase price, but what I'm observing on transactions that are coming over the wall is that there is a shift away from bank financing at the moment, just because interest rates stink, and more reliance on seller financing. At the end of the day, the seller wants to get the deal done. They want to get the most value they can out of their practice. And if it means that they have to carry paper at a lower rate than what a bank would charge, they're willing to do it. So is that similar to what you're seeing with transactions you're working on, David?
Yeah, I mean, time and time again, I have firsthand heard these people as the seller talking about, well, shoot, if you got to pay 9%, that's going to impinge on your cash flow and your ability to give me the value that I want, unreasonable as it might be. And so I'll handle the financing. I'll do it for the low rate of 7.5%, which is by any measure on a 10-year payback, but not a terrible return given their perceived risk. So yeah, and the hard part is, again, it's all relative. Like we're seeing a decrease in the use on external bank financing. Well, you go back 10 years ago, there was 0% bank finance deals because there were no industry lenders. Fast forward to where we were 2019, 2021, like 80% of deals were using some kind of third-party financing, either from their broker dealer, occasionally custodians and other firms, but a lot of industry lenders, your usual suspects. So it really spiked because most sellers, they don't want to loan the money if they can help it. I mean, you wouldn't loan money generally to your family member, at least not the money we're talking about, hundreds of thousands or millions of dollars. They don't want to lend it to their family, let alone appear in the industry, but they would do it begrudgingly because there was no other option. Then bank financing became an option, and it was plan A and plan B. And then, you see the interest rates, and all of a sudden you're starting to see sellers come back in and raise their hand and say, you know what, I don't love it, but the 7.5% interest you'll pay me, or 7% or 6%, I mean, it's still not terrible. It's enough to offset their perceived risk of financing it. So again, it's not like it's an overwhelming majority now. 100% of the deals are seller financed, to your point, but where it used to be sort of the weird anomaly, a family business, you see it pop up. Now it's 1 in 3, 1 in 2 deals. There's some seller financing. So it's getting talked about a heck of a lot more, which I gotta tell you, it complicates the deal. Like now you're talking about how do we collateralize this promissory note? What happens, if we get to year 8 or 9, there's not much left to pay and buyer just stops paying me. I mean, it's hard being the bank. So just go in with eyes wide open if you decide to put that on the table as a seller. So the end of Jeff's question was basically, how do I time the market? How do I time the sale of my business? The hard part is, Jeff, honestly, if you wait for rates to go down, it may free up some cash flow for your buyer. That's not wrong. But you may find yourself, like all things timing the market, waiting 2 or 3 years. And then, well, now capital gains tax rates have gone up, or the market's terrible, but the interest rates are down. Like in general, I know I'm preaching to the choir here, but I would focus less on timing the market because you will probably inevitably get it wrong. That old saying, anytime you got a 50-50 shot, you got a 90% chance of choosing wrong somehow. So I wouldn't try to time the market if I could help it, or if I were you. Again, your business is probably one of your most valuable assets. And to Ryan's point on the interest rate, these deals are cash flow positive enough that, it hasn't helped the wheels of commerce, but it hasn't derailed them either. So I would just focus more internally, what your clients need, your timeline, desire to keep working. There's a lot of, well-qualified buyers that they don't love the interest rate, but they're still doing deals. They're still out there. Let's go to a question from Jason Benham, good friend over at Ameriflex. So he asked a good question here. So how do valuation multiples change, if at all, by like advisor affiliation model, sole practitioner, ensemble, so that hub and spoke RIA model? Do you see any variation, or just everything sell for the same, multiple?
And the actual organizational structure of the practice and affiliation isn't necessarily going to swing the valuation results one direction or another.
Sure.
Size will have an impact on valuation. How scalable, reliable, and repeatable revenue is will have an impact on valuation. So if you have a fee-only RIA, it's going to be very comparable to a fee only or a fee-based practice that's affiliated with a broker dealer.
Yeah.
Now, a potential limitation, depending on the size of the broker dealer and the marketplace, that can, or the market within that broker dealer, that could have an impact on the value of the business, because it's going to have an impact on your market and who you can sell to. If you're with a smaller broker dealer, it's a smaller network. Therefore, your opportunity to sell it within that network is reduced. So it may take quite a bit longer for you to sell the practice if you can't even sell it within that network.
Yeah. Okay. And I'll answer your question here. Dan Landrow joining. Thanks for joining us, Dan. So Dan's question, and I'll just answer this one because it is carrying on our conversation about the bank financing versus seller financing. So Dan's question here, have you ever seen buyers, renege on, third-party financing? How does that play out, frankly, for both parties? So this is the challenge when you have seller financing, is you're the bank. I mean, you're probably not great at collections, and that process from a legal perspective takes time. It sucks. It's not great, practically or technically. And it's why when people do decide to do seller financing, it shouldn't be to earn a 7.5% or 6% interest rate or whatever it is. It should be for some other compelling reason, because really, when you start looking at the risk profile of, lending on a small, closely held business that doesn't have any collateral, technically the interest rate you should be charging that's commensurate with the risk you're taking relative to what rate you would get for other levels of risk. You'd be charging double-digit interest rates. I mean, to really offset your risk with the financing,
Yeah, I mean, when we typically in the world of valuations, for valuation modeling purposes, when we have to estimate what the cost of seller financing is, buyers and sellers, they're coming to terms that work for them in the world of valuation. When we have to assess what the actual cash value of those assets are, the commonly accepted approach is using the seller's cost of equity, which, to your point, is in double digits. It's upwards of 19-20%.
Yeah, I mean, it's expensive when you really start looking at the level of risk you're taking on paper, because to Dan's point, And I know we obviously, Dan, asking the question because your firm provides financing. That's the nice part with the third party financing is the seller, you get a check. Whether the buyer pays their broker dealer or the bank back is, interesting, I suppose, but does not really matter to the seller. And it's a nice position to get to, at the end of a career, to not have to turn your business into an annuity, just get paid. And if you want, go buy an annuity. So seller financing, it has its benefits. I mean, I will tell you, it's fast, it's easy. There's no origination fees. Buyer and seller get to do all the underwriting. If you've ever been through commercial financing and underwriting, it's not great. You will not want to do it again. You will, because it's just a necessary step. But seller financing is fast, it's easy as long as you all agree. But you want to make sure you have proper security and collateral. And that's just kind of a hard conversation. So yeah, good question, Dan, because it's coming up more and more, and it was not something that came up a whole lot previously.
Yeah. David, there was another one I want to touch on from Jeff on best way to structure the sale to reduce taxes to the seller. There are two important points there, and I'll turn it over to you just to talk about what you're typically doing in terms of deal structuring. But there are three general components to a purchase price, and this is not often understood by business owners. There's the value of the assets, there's post-closing consulting, and there's a non-compete. So from a tax perspective, those three factors have different tax treatment. And why this is important is when we are doing a fair market value assessment for gifting of shares, or very commonly for divorce purposes, we have to value the assets of the business. And when we talk about average revenue multiples being over 3 times top line revenue, that 3 times multiple does not apply to just the assets of the business. It is based on the purchase price. And that purchase price has those three components: assets, post-closing consulting, and non-compete. So when we do our valuation analysis for those specific purposes, we have to bucket and isolate the value that is assigned to those service agreements, specifically the non-compete and post-closing transition consulting, because those are not assets of the business. Those are seller services that are provided post-closing. Now, to that end, all three of those factors, like I said, have different tax treatment. So in order to create the most advantageous tax situation for the seller, it's going to be having all of that purchase price allocated to the goodwill, where you'll have long-term capital gains treatment. The post-closing consulting for the seller is expensed in the year that the service is provided. It's recorded as income to the seller. The buyer is expensing it in the year that the services are provided. And non-compete is same. It is considered income to the seller. Buyer can amortize that over 15 years. So in terms of normal allocation on deals that you're seeing, David, what's common right now?
Yeah, I mean, it's been pretty consistent, getting a little bit better from a seller's perspective each year. But I mean, it's to give you safe ranges, you can probably plan on 90 to 95% of the deal is going to be allocated and paid for those client relationships, personal goodwill, that 15-year amortization you were talking about. And you lately been leaning closer to the 95 than the 90, but it varies a little bit from deal to deal. The consulting and the non-compete, they usually sort of divvy up that remaining 5, maybe 10%. But again, more often than not, it's like 5 or 6% of the deal between those two. I would also say, just from a tax structuring and tax mitigation perspective, the buyer and seller, like price and terms, are kind of at odds. What's good for the seller is usually not as good for the buyer, and vice versa. But there are instances, Jeff, your other question here, if you were going to be selling in 20 months, you don't need 20 months to do the tax planning, but start the process early enough that we can get a little bit creative and see if we can let both buyer and seller have a win. And even when we're dealing with a C Corp RIA, I mean, just to take the most complicated scenario where clients have engaged with the C Corp directly, like there are still ways we can get creative. 9 times out of 10, and give both buyer and seller a pretty cool tax outcome. Trouble is when we get these phone calls and people are ready to retire like yesterday, you don't have a ton of time to get creative, especially not when you get near tax season and the CPAs aren't even available. So it's a big decision to sell the business. 20 months, to your follow-up question, Jeff, that's a great point to start thinking seriously about the mechanics of the deal, who the buyer is. You probably know that, that you got partners. I would start that planning process. You probably don't have to do it 20 months out, but maybe 19. You really can't start this process early enough when it comes to succession planning and the transfer of trust, the clients and the relationships, the roles and duties day to day. I mean, there's just a lot. It's not complicated, but there's still a lot. So good questions from Jeff. Again, just getting very practical here.
Hey, Dave.
Yeah, please.
One follow-up question for you on identifying a lender. So what's best practice for choosing a lender, like a local bank, a more nationally known bank, Live Oak, for example?
Right.
How do you go through the process of vetting a lender and deciding who to move forward with, other than finding one at the best rates?
And honestly, I would tell you, there are folks out there who are shopping for rate. Don't shop for rate. If you're getting a mortgage or a car loan, knock yourself out, hit Lending Tree, Rocket. I don't care what you use, but like, you're shopping for rate. Like, the product is the same, especially in like housing, because it kind of has to be. It's so heavily regulated. When you get into commercial financing, you could line 5 or 6 different industry lenders, not even getting to the regional banks that you talked about. Industry lenders, they know the space. You could line up 5 or 6 different industry lenders, and you will talk to them and find out from the first 1 or 2, like, oh, your deal's unfortunately it's just not bankable. And then they'll come to us with the expectation that now we have to deal with seller financing. Well, the deal falls apart. It's not that the deal is not bankable. The deal's not bankable to that bank. But each of their credit boxes, what gives them the warm and fuzzies, is totally different from bank to bank. And where there's consistencies, there are still differences in their loan covenants, basically how they treat certain deals. Their ratios are all different. So basically do one of 2 things. Either get the entire list, which at this point is probably 8 or 9 dedicated industry lenders or brokers, and call every single one of them once you have an idea of what it is you want. If you call them without knowing what you want, they're going to tell you what they want, and you would generally not like the answer. So lead the charge. Again, they are there to support you as the buyer and put together a loan solution that works for your deal. Yes, they have certain parameters they have to stay within, but most of them can get pretty creative, and they will, to help support you. If you don't lead that charge, they will still get creative. Just it won't be your deal that they're doing. It'll be their deal. So you either call all 8 or 9 lenders, which will take you a small eternity, and you will start looking like Ryan, and you will finish, looking like me. Or we had built a tool. It's out there, it's free. So this is not exactly the best promotion in the world, but lending-well.com, lending well. It is an evolved spreadsheet that we had internally of every industry lender, all of their loan covenants and requirements, basically the good, the bad, and the ugly of each lender. And we used to use that spreadsheet here internally to guide you, our clients, as the need came up. But we were getting just so many calls from people who weren't even clients that we still wanted to help. So we ended up basically taking that spreadsheet and having our developers turn it into an online tool. So you can go hit lending-well.com and just ask you a couple of questions to help narrow down what it is exactly that you're looking for, and then just connects you with the right 1 or 2 lenders that we already know this is the type of deal that they like. So just selfishly, when you work with us, it's nice when you show up with the right lender. When you show up with a lender, we'll still help you, but you won't enjoy the process. And incidentally, neither will we. And commercial financing is not fun anyway. So if you can at least have the right lender, I'm not going to say it's going to make it fun, but it will make it marginally less painful. We had a question from Lance. Welcome back, Lance. We actually did have the opportunity to work together. I mean, it's probably been 12, maybe 15 years. But yeah, I do remember our work together. So Lance's question was, how do you help clients like an RIA buy a practice from another firm? And frankly, whether there's RIA from one firm to the other, like how does that impact valuation? I can say from a deal structuring perspective, it definitely gets incorporated. Would you say that, based on who you're selling to, impacts the value of a business? Ryan, your thoughts?
Not necessarily. There are pluses and minuses. So if you're selling if you're selling across broker dealers, there typically is a transition that takes place prior to the sale. And that transition usually is seller transitioning to the buyer's broker dealer. So in that scenario, does it increase potential client attrition risk? Yes. However, in most third-party sales, this is a statistic that most people are floored by. The retention rate is higher than 95%. So as long as the transition is structured appropriately and that there's enough time for the dust to settle from making a transition from one broker dealer platform to another, then transitioning the clients to a new service provider, yes, it does potentially increase risk, but we're not going to just discount that on the valuation because there may not be any attrition. It's also going to depend on how familiar buyer and seller are with each other, how the introductions are made to the clients. But this is where an appropriate, like to your point, Dave, how deals are structured to make sure that there are actual adjustments tied directly to the clients that are retained versus those that are not, as opposed to discounting it on the front end through the valuation. Because if we discount it on the valuation and you build it into the deal terms, you've now double dipped in terms of discounting.
Yeah, no, perfect. Thank you. And yeah, you're spot on, Mark. Yeah, lending-quell.com. Our moderators will drop it into the chat for you as well, so you don't have to go try to hunt for it.
They're interested.
Oh, that's perfect. Good. There you go. So on the succession-related questions, which we've kind of tap danced around indirectly already at this point, but Greg had a couple of questions on some internal succession stuff, which is the opposite of Lance's question. So Greg asked, is my business worth more or less if I sell it to my internal team? Loaded question, but there you go.
So over the long run, yes, it is worth more. However, when you are doing a multi-tranche succession plan and selling internally pieces of the company, those transactions by themselves independently are not going to equate to a pro rata value of the firm. So you're selling a 5, 10, 20% interest in the firm. You are selling an interest that is not marketable. It can only be sold internally, and there are no prerogatives of control. Therefore, there are typically discounts for lack of control and lack of marketability. So most people go into these transactions not aware of those discounts. Now, there are countering effects there, and it depends on how the deal is structured. So in most cases, it would be ideal that if you're buying into a firm, you go source your capital. You go to a bank,
right?
Tap your home equity, you buy into the firm with the capital that you have available to you. In those scenarios, you bet there's going to be discounts because there are risks beyond their control in the stake that they acquired. If there's seller financing where the company is acting as a bank, then should you discount it? And because you're effectively allowing them to buy in with your money. In those scenarios, it's not very common to see discounting. So the short answer is, if in an internal succession plan, you're never going to get less, even though you may sell minority blocks of stock that are a minority interest. At the end of your career, when you decide to transition your controlling interest, if there are discounts on the front ends, there's going to be premiums on the back end for that transfer of control. So it will make you whole again in terms of the complete value of the firm. One of the benefits of financial advisory practices are values are constantly on an uphill slope. So they're increasing. And as such, with a growing firm, when you sell blocks of stock over time, you're going to sell them for more. And then at the end of your career, when you end up selling the whole firm or your controlling interest, it can have a materially different value than it did when you began the multi-tranche sale. A outright sale to a third party is going to create, in most cases, a liquidity event right then and there. And it's not that it's going to be worth less. You're just isolating a point in time when you're selling it.
And you mentioned discounts, and then I had it teed up as my next question anyway that was sent in, and then Helen asked it. So what typical discounts, minority discounts, what are you seeing? What's the average range? Or is there one?
For corporate governance documents are really going to dictate what those ranges are. As long as you offer a one share, one vote, and you have buyback provisions that are fair and equitable, that are based on fair market value of the firm, and you have a defined transition process, such as they can be offered to the company, they can be offered to members, or they can be sold externally. If can't be sold externally, then the company will buy internally. You're going to see significantly lower discounts, because effectively what you're doing is creating an internal market for the company or for the shares. So what I typically see collectively is going to be anywhere on the low side of 20% collective for marketability and control. On the high side, I've seen it as high as 35.
Okay. So that's a pretty safe range.
Correct.
Okay.
On average, it tends to come out to about 25%.
Yeah. I mean, that's the funny thing is I read articles on this. We go deep on it, obviously, because it's our bread and butter. But most even CPAs who will opine on this issue with their clients, you, the advisor, will hear them, come back and say, oh, it's typically 20% or 30%. Typically, it's based on your governance documents, like Ryan mentioned, which is how somebody, like him or his team actually get to an informed number, because not every company is the same. Some have tons of protections for minority shareholders. Other documents I've read, you read it and you think, how did anybody ever buy into this company? Like, there are so many safeguards for the founder that it would be so heavily discounted that nobody would even transact it. So there are ways to get to the number, but it does vary from company to company. But I appreciate you not dodging the question and giving an actual answer. So a couple more quick hitters here then, as we get precariously near the top of the hour. We have a ton of great questions. For those of you that we didn't get to your question, we'll just follow up with you offline as well, because we appreciate you taking the time to ask them. So AJ had the question here: can we provide guidance on structuring, transition, sale, gift to an adult child? I mean, the hard part is assuming that it's an adult child who is in the business, i.e. working with you. I get what you say when you say gift. It isn't a gift anymore. Like, you may get some CPAs that will still feel comfortable calling it that, but the fact that they are related to you would be one reason to call it a gift, obviously, detached and disinterested generosity, which is what the IRS requires for a gift. But when they're on payroll, it is neither detached nor disinterested. They're an employee. The fact that they have to be related to you is interesting academically, but that's just likely to bring more scrutiny than less. So when it comes to gifts, you can give things to people, but again, a gift is the detached and disinterested. Otherwise, it's a grant. You can still give it to your adult children or nieces or nephews, or just employees who are amazing on your team that you want to keep. You can give them equity, real equity, phantom equity. Just know that technically it is and likely should be taxable to them. But again, there's ways to mitigate that. Minority discounts, like Ryan mentioned. If you build a really oppressive operating agreement, you can probably slash that value in half. But there are ways to mitigate it, but it usually doesn't actually fall into the gift category. But there's lots of other things you can do in a family-owned business. Self-canceling installment notes. I mean, we can get pretty creative. So it's a tough one, AJ, and we're happy to take that conversation offline. It's the stuff our team does on succession planning all the time. But one of the questions here from John, this all close us out. Structure, I know you are familiar with, given your background. So the question here from John is, does the sell and stay approach change valuations or the structure, such as more allocation to the consulting, for example? And sell and stay, for those of you who don't know what that means, buy and hire, sell and stay, it is a descriptor of what a lot of deals are doing now, which is I buy Ryan's practice, And then he doesn't want to retire, but he also doesn't want to keep working full time. So I hire him back to work 10 or 15 hours per week, servicing top clients or being a rainmaker. What are you seeing as far as valuations go, Ryan? Does that have any impact on the value, just the deal structure?
It doesn't. So there are two separate needs that are being addressed here. There's the value of the assets. Those are isolated. That's what you're selling. Now, there are your needs as the owner of those assets and wanting to be an employee and stay on. So the acquiring business, they pay for the assets.
Yep.
They acquire those assets. Now they hire you for the services that you're going to provide to the firm moving forward. Those services may be servicing your book of business. They may be helping bring in additional clients and new referrals to the business. So two separate conversations, but the fact that it is, I'm wanting to stay on at the firm that acquires me isn't going to have an impact on the valuation results. It is going to be a direct reflection on how the deal is structured. Assets are valued separately. And then depending on what your services are for what you'll be providing the firm that you stay on with will determine what your compensation is. So, and part of his question was, does that change the portion that's allocated to the consulting?
Right.
It can.
Right.
And, in some of those cases, it could be, no consulting because we're hiring you on
right
as an employee or a contractor. So we're going to buy your assets and your goodwill and then have a separate contract for you for a longer term consulting arrangement.
Right. Yeah. I've had folks and seen deals where I think let's just have dealt with each subject in a vacuum. And you basically end up paying them as a consultant to transition the clients, but you're also paying them as an employee to keep working and servicing, which when you're done and the CPAs are looking at it or anybody else objectively, they'll be scratching their head wondering what exactly you were going for. So it can, probably should in many cases impact it. But the cool thing is when you look at that sell and stay, buy and hire, like where the seller doesn't sell, transition the clients over 6 months and then right off into the sunset, the retention rates are surprisingly high. And by high, I mean like when you measure a year after that deal has closed and the seller is still there part-time, usually the business ends up growing as a result, where most transactions you're shooting to keep like 90-95% of the clients and the assets. When you can keep the seller around and give yourself a little bit longer runway, it's pretty cool to see flipping the script on our projections from like losing 5 or 10% to picking up 15. That compounded growth thereafter, man, that really adds up over like a 10-year debt service window to pay that thing back. So if you can give yourself time, you, the clients, the buyer, the seller, everybody gets a fair amount of benefit from it. We just need 2 to 4 years probably. So any closing comments, any questions, anything we haven't hit on already, Ryan? I know we're already at the top of the hour. We had a ton of good.
Just want to add a little more color to the comment on the sell and stay portion for the consulting. So as I mentioned earlier, that the purchase price consists of 3 components: the assets, the consulting, and the non-compete. In the sell and stay, I have seen this where albeit the consulting is a very small portion of the total purchase price, but since there's a separate arrangement that portion of the purchase price does get pulled out. So let's say it's a 5% allocation of the purchase price, that yes, the total purchase price, it doesn't change the value of the assets, but the total purchase price would be reduced because that consulting is being served in a different capacity.
Yeah, got it. Okay. Well, everybody, I appreciate you sticking with us here during our session today on value and valuation. Hopefully you got some good insights from our esteemed panelist here and your amazing host, obviously. We dropped into the chat window as well, just our contact information. If you want to get connected, have a conversation offline, one-on-one, what our team is designed to do, what we spend a lot of our time doing is helping diagnose. And then we've got our next SRG Off Script coming up right before tax time, April 13th. So watch your inboxes. We'll get more information out to you on that. But with that, folks, we are signing off. Hopefully you enjoyed this SRG Off Script live. Be well. We'll talk to you again soon. Ciao.